Good afternoon. Today is Tuesday, March the 14th. Right, the time right now in Singapore is 12:23 in the afternoon. Overnight on Wall Street, we still see the fallout from the bank failure over last week, and again on Sunday we were told that another bank went under. This time, this bank is even bigger than the Silvergate, which is 10 times bigger than Silvergate. This bank is called Signature Bank. When you compare Silvergate total asset as of the end of last year, it was at $11 billion in assets. The Signature Bank collapse over the weekend was actually 10 times bigger at $110 billion. So we can see that one after another, the fallout from the FTX debacle is still having its ripple effect on crypto market, and so we are likely to see an extension of the crypto winter. Although we have seen Bitcoin and Ethereum has actually surged on the back of this bank failure. So later on, I will go into a little bit as to why the Bitcoin and Ethereum are enjoying its days in the sun, whereas the rest of the crypto market is practically dying. Okay, later on we'll go into the reason why. But overnight on Wall Street, we can see that Wall Street continues to sell off, and despite the Federal Reserve, the U.S. Treasury, including the FDIC, which is the insurance corporation that guarantees depositors' funds, they came in and said they will make good all the depositors' fund at no cost to taxpayer. There's no such thing as no cost. Okay, so the thing is that although President Biden and Janet Yellen, the current Secretary of the Treasury, come out and say there will be no bailout of the banks, but what they did by mentioning that they will make good all deposits is essentially a de facto bailout. So judge them by what they do and not what they say, and that's always the case here. So we can see that at some point right now they are just pretending that this crisis can be managed, and by doing some creative accounting, by taking in all the underwater treasuries and then treating them at full value, and about despite the fact that those treasuries are basically underwater by a mile. Okay, so basically we are seeing some kind of pretend belief that they are worth as much as they were last year. Okay, so that's what they claim to be doing to actually avert a financial contagion here. But we can see Dow Jones is still basically selling off. Dow Jones actually went down to as low as 31,630 overnight before recovering somewhat, but it still closed on a negative basis, although it is not as severe. They are only lost less than 3%, 0.3% to close at 31,819 thereabout. So we can say that the market trajectory thus appears to be suggesting further losses is in the book, and if this market continues to trade in this current trajectory, there's a possibility the market may be heading towards 31,265 to 30,900. So between these two prices, hopefully there is going to be some kind of technical support emerging. So we will have to see what happens in the for the rest of this week. Now, don't forget on Thursday, on the 22nd, which is no, sorry, not this week, next week. This week, tonight we have the CPI numbers followed by the PPI numbers. So again, we are going to be looking at those inflation numbers and decide whether the Federal Reserve is going to take its foot off the pedal, or is it going to maintain a very restrictive monetary policy going forward, despite the banking crisis that we are witnessing right now. Okay, over in the S&P 500, we can see the prices continue to trade below the rising channel, and this is the third day it has been trading below the rising channel. Based on the 4 hours time frame, we can see the prices went up to as low as 3,808 before rebounding somewhat to close marginally below the Monday's closing price. Today's Tuesday, so it's Friday's closing price. So it was marginal, no major losses here on a close basis. Okay, but the phenomena here can be seen in the Nasdaq 100. So we can just maybe I'll show you the daily time frame to give you some kind of perspective. Okay, in the daily time frame, we can see that the Nasdaq actually closed in a positive territory. So this is very much unlike what's happening in the Dow Jones. Currently, the weakest link among the three major equity index is the Dow Jones, followed about the S&P 500. So conversely speaking, this is something very different from what we see last year. Last year we can see tech stocks was actually leading the way down, but this year we can see that tech stock is actually not falling as much. In fact, it is actually holding the line pretty well. And overnight we can see the Nasdaq 100 actually closed in positive territory, up by 0.8%, actually climbing something like 93 points. Okay, so now this structure still is going to suggest that because we have a larger degree three wave, we are still on course to drop to somewhere between 11,170 to 11,520 levels. So this is still my immediate target range. Let's see whether the market will eventually go to that point. Okay. Interestingly, if I include another index, this is the Russell 2000. This is again showing that there is wholesale selling in this small cap index. So we can see that this is a waterfall kind of a collapse. So it may be something that we will be seeing in the other premier indices going forward, because if it's already happening in the small cap, eventually the same sentiment will spill over into the other major equity index. So this is something that we want to take note of. Okay, so I think by tonight this market is going to go even lower. Okay. Over in Asia itself, we can see the Nikkei continue to edge lower. We have 3 gaps down in the 3 days in a row. Currently, this morning market hit a low of 27,104. Although right now it is a little bit stable, but it does looks like this thing is going to fall off the cliff. Okay, and the only thing that's holding the market right now, technically speaking, is the low here traded on February 22nd. The low here is 27,000. So this whole number 27,000 is going to be the defending line. Okay, if this line this line in the sand is breached, then we can see much lower prices going forward. Going against the grain is actually the Chinese stocks over in Hong Kong. You can see that yes, market has actually taken out this near-term support line at 19,335 with a low of 19,193 this morning. But on a close-to-close basis, we cannot make that call right now until the end of trading today. Okay, so we still have half a day for the market to go back up again. And on a close-to-close basis, it is very important the market do not close below 19,335. Over in the CSI 300, which is a major equity index in China, we can see the same thing. Although we have a marginal low for the day at 3,947, but the market right now may have a chance to actually sneak back up again. But upside will be quite limited because the market here has a very clear rising channel here, and this blue line over here that we saw used to be the support, now turn resistance, is going to be a big barrier to cross. And if the market ever rebound, it's likely to be kept below this support turn resistance. Okay, over in commodities, we can see there's a bit of gyration going on in energy markets. Crude oil actually went down to a marginal low for this month itself, $72.27 before it started to see buyers coming back up. Okay, but by and large, you can see that it is still consolidating between $72 and $81. So by and large, until market breakout of either of these two barriers, it may still stay in consolidation pattern. Okay, natural gas is the one that was actually giving me a little bit of heartache last night, because I was actually long going into the market going down, and I was very confident that it will hold. But because I was trying to tighten my stop, I did a fatal basic mistake that most traders would do, because I tightened my stop too close to the market action, and I got stopped out. And then what happened thereafter was heartbreaking, because the market actually rallied. So this is something lesson 101. Do not be too afraid to put your stop further away. I should have put it below 195, but I was a little bit concerned with the volatility, so I tightened my stop to just below the most recent low. And what happened? The market have a marginal low, took me out, and then reversed. So this is a novice trader mistake that I made overnight. So again, there is no saying that the longer you trade, the wiser you become. I still make basic mistakes. Okay, now this market does look like it's going to go in the 3-wave rally. My target remains at $3.45. I hope that I can have a better chance to reestablish my long position, although it won't be a better price, because I was actually bought below $2.50. Was actually a very, very nice position. So I took a small hit, but we can't cry over spilled milk. Okay, so over in currents, in precious metal, we can see again when everything hit, when when everything hit the fan, we can see that traders and investors are looking for safe haven. Typically, where would they hide? They will get out of riskier assets as equity markets, for example. They will hide in the safe haven like US Treasury. So we can see a lot of funds has actually parked into US Treasuries since last Friday after news broke that SBD has gone under. Okay, and the other asset class that most investors and traders will actually find safe haven in is actually precious metals. So we can see there is a big rush to go into precious metals, and this is by far the best performance in 6 months we have seen in gold market. Gold went up on a cash basis, went up to $1,915 thereabout before we pulls back a little bit. So we can see this move here is 1.618 distance, meaning to say that after a short consolidation period, it will likely to go beyond 1,915 one more time, perhaps to challenge the 1,960 before it actually meets some kind of serious selling interest. So by and large, we do expect another rally going forward after a brief pullback. Okay, over in silver is a Johnny come lately. On Friday, silver did not move very much. You can see this is the daily. I'll show you the daily time frame. You can see that based on Friday movement, silver market hardly budged. Okay, it managed to hold its bottom at $19.90, but it did not see the same kind of rally that we saw in gold market. It only started to move yesterday, and boy, did it move. Market went down to $21.93, and it does look like the market has hit an immediate barrier to higher prices, which is likely to be contained below this price here. This is the barrier of entry here. The market is $21.98. So once the market can clear and close above this level, there's nothing stopping this market all the way until $24.64. So do watch out for an extended rally in precious metals going forward. Okay, and then in dollar itself, we can see the dollar index has actually come off 3 days in a row after hitting a peak of 105.87. So we can see that this pullback is accelerating. For a time being, we can only take it as part of a corrective pullback. Maybe we will still be able to see a 3-wave rally, maybe even more. But until then, we will have to treat this as a technical pullback with the eventual return of the rally. Okay, back to challenge the 108 level. But until the market stabilize, we do not know. Ideally, we see a 3-wave and then market stabilize somewhere near the 102, 40, or 50 levels, and then stage another rally. But again, we will have to see how the market unfolds. Now, in the midst of this dollar pullback, we can see that sterling has been very aggressive. You can see that sterling rally is the most pronounced among all the major currencies. You can see that the sterling settles down at 118, managed to go up to 122. So that is a 400 points move in a very short span of time. So this is actually showing us that when the dollar is pulling back, the current major beneficiary is the sterling. So this momentum looks very strong, and it is likely to continue higher. Okay. Over in the euro versus the dollar, the rebound in the euro, it wasn't as spectacular as what we saw in the sterling market. So the high it managed is only 107.5 thereabout from a low of 105.25. So we can see that the market did not move 400 points on as what we saw in the sterling market. So on a relative basis, the euro is weaker on a comparative basis. So this means that the market at this moment in time, we don't see the very aggressive move to the upside. There is a danger it may actually come back down again. Okay, over in the Aussie, okay, this is actually a dilemma, because usually when gold prices surge the way it did over the last 48 hours, it should actually rub off in the Aussie dollar rate, but this time we don't see the major run up in Aussie. In fact, on a comparative basis, it's actually quite muted. So not sure what is causing the Aussie to be so cautious and not be able to benefit from the rise in gold prices. But again, this shows that the market is basically quite weak. Okay, now when we see the dollar index, this is exactly what we see, a mirror image in the dollar yen from 137.90 all the way to 132.30 levels. We can see that this big move here, more than 500 points, it happens within 3 days. So we can see that this massive sell-off in the dollar is very evident in the dollar versus the yen rate. Now again, very similar to the structure in what we see in the dollar index. This looks like a for the time being, we can only categorize this as part of a retracement. Possibly once the market stabilizes, ideally above 131. 10, then the market may be able to stage another leg of the three-wave rally to test the 140 levels. Okay, so we will have to see what happens if the market continue to slide and trade below 127.20. Then all bets are off. Okay, so for the time being, this is all that we can say, that the dollar itself is having a technical pullback. Now, when we see the dollar decline, we don't see very evidently in the dollar versus the Canadian rate. The dollar Canadian is actually a high of 138.60. Only pullback, only marginally. Yesterday, the low was 136.70. So we can see that it is only slightly beyond 100 pips. So we can see that the dollar versus Canadian is actually very stable. We don't see the kind of pullback that we saw in dollar yen. But when you look at the structure for 132.25, this appears to be an equality move in a three-wave rally. So what does it mean? It means the market may come off. Okay, so this is what it does suggest here. Okay, now over in the crypto market, like earlier on, I did mention when there is a flight to safety, the US Treasury is the number one instrument people will find safe haven in. The other one is precious metal. Now the third one currently seems to be crypto, but not so much of what is happening to the overall market. It is more related to stable coin. So remember, over the weekend, another bank failed. This one is called Signature Bank, and this bank is 10 times bigger than Silvergate, which actually went bust middle of last week. Okay, so where Silvergate is rumored to be to have an asset about $11 billion at the end of last year. Now, the Signature Bank is having assets of $110 billion. So that was even that size is not able to protect them from the fallout from the FTX. So the FTX debacle is still having ripple effect in the crypto market. So what happened is that over the same period on Sunday, Circle, which is another crypto player, say that they have assets that are locked into SBV, which is the Silvergate bank, and no, not Silverbank, the Silicon Valley Bank. Okay, and market took it. They're not sure how much is exposed, so they started to attack the stable coin. We saw a bit of a surge in withdrawal from the USDC, which is the stable coin called the US dollar coin issued by the Circle. Okay, so but when the dust settled, they realize that only 10% is exposed to SBV. Okay, so by the time the damage is already done, the dollar peg in a stable coin theoretically should be $1 to one. It should be equal value. Okay, it should be backed by $1. But that peg actually was broken momentarily to 87 cents to the dollar. So as the withdrawal started to accelerate, a lot of major institutions started to dump stablecoin and bought crypto, only the main coin, which is Bitcoin and Ethereum. That's why you saw the big move happening on Sunday, which extended into yesterday morning and then accelerated during the New York trading session to a high of 24,481. Now, this is a 20% move from 19,570. Okay, so this is a big move on just 3 days of trading. Okay, so anyway, this is what the market is behaving right now. There is this there's this shift towards the dominant coin other than in stable coin. So for a period of time yesterday, there was a lot of rumors whether the stable coin is going to be viable. Okay, and it also spilled over to the other stable coins. But by yesterday night closing, the peg in the USDC has gone back to 99 cents to the dollar. So it has improved over a 24 hours period. So we will see whether that is going to help stablecoin, because if that is the worry that has been removed, then what goes up may eventually come down, because this is in reaction to the worries over stablecoin. So once a stablecoin peg is back to normal, then the buying interest will have to unwind. Okay, so do watch out for this potential move in Bitcoin here. The Ethereum is also rising on the same reason as Bitcoin. As you can see, the market was actually going down towards on Friday itself to $1,369 or $70, and then over a 3 days period, the market ran up all the way to $1,690. Oh no, go all the way to $1,700. Okay, so we can see that this is also a major run up in Ethereum prices on the same rationale as why people are buying Bitcoin, because you can see in the other coins we don't see the same thing. This is Ripple. There's hardly any movement in Ripple. We look at Dogecoins, we don't see the same thing. So you can see that it is only peculiar to the Bitcoin and Ethereum. So once the panic over stablecoin is more or less removed, then the reason for buying Bitcoin and Ethereum overnight do not appear, and it's no longer valid. So do watch out for the potential reversal in these two coins here. So watch out for tonight. We have CPI and PPI. In the meantime, I will give you another update tomorrow. In the meantime, take care. Bye-bye.